Hello people, welcome back after that break. So continuing our marathon discussion, we're going ahead with Accounting Standard 11 that talks about effects of changes in foreign exchange rate. The scope of this standard is very straightforward. If you have done any transaction other than Gandhi note, other than Indian rupees, any transaction not done in INR but in any other currency, how it should be accounted is the scope of Accounting Standard 11. These days now, it's quite common, right? We export the goods to other countries, we import it from other countries. All this cross-nation transactions are quite common. So all that will come under the scope of Accounting Standard 11. So before we dive into the questions, there are some small concepts. Again, it's a numerical standard, right? But to solve those numericals, we need to be aware of the provisions. So let's run through the provisions and then take up the questions regarding this. Sir, broadly AS11, if you have to analyze, you can put that analysis under two categories. One, if you have foreign currency transactions, what to do? Second, if you have foreign operations, what to do? That's all AS11 is predominantly covering. And there is a lot of similarities between AS11 and Ind AS 21 and CA final. Significant overlap is there. So this will continue. Concepts will continue in CA final also. So it covers only two things. What are those? Foreign currency transactions and foreign operations. Foreign currency transaction means you have purchased a machinery, let's say from other country like Japan, or you have sold goods to a customer in US. All that is a foreign currency transaction. That is one aspect AS11 gives the guidance. Second one is if you have a foreign operations. Foreign operations means if you have a subsidiary company outside India, associate or joint venture company outside India, or if you have any branch outside India, how they should be accounted is the foreign operation aspect. Both we will be running through over here. All right. So now before we get to the numericals, certain meanings you should be aware of. One is a monetary item. I think we have discussed this. Monetary item means those components whose value is fixed. Okay, example could be cash in hand, cash at bank, debtor, creditors, loan taken, loan given, etc. etc. So on loan you will pay interest, no sir, value will change, no. If you take 1 lakh principal of loan, how much will you repay? How much principal will you repay? 1 lakh only. Is that changing or fixed? Fixed. So loan given, loan taken also is a monetary item, right? So monetary items are those items whose value is fixed. If value is fluctuating or changing, we call it as what, sir? Non-monetary items. So you need to identify, whenever you have done a transaction, you need to identify whether the transaction relates to a monetary item or a non-monetary item, because the conversion rates are different. That's the reason identification of monetary, non-monetary becomes important there. All right. Next, foreign operation, as we have discussed, foreign operation simply means you have any branch, subsidiary, joint venture or associate company in India or outside India? Outside India. They're not doing activities in India, but rather they are doing activities outside India. So foreign operations are further subcategorized into integral and non-integral foreign operation. EFO, NEFO you can call it. EFO as an integral, NEFO as an non-integral foreign operation. Integral foreign operation means you have two entities, one in India, outside India. Indian entity and outside entity are all highly interconnected. If it's an interconnected organization, we call it as what, sir? Integral foreign operation. Like I used to give you examples of Infosys, if you remember. Let's say Infosys ka head office is there in Bengaluru. They have a branch in US. Let's assume they have a branch in US. Now this Infosys, no, they are developing a software. They are developing a new software. 60% of the software is done by Bengaluru, Indian entity. 60% of that software is developed by Indian entity. Balance 40% is developed by US branch. Now you tell me, are they not integrated? To make this software, India and US has to work together. Now this US branch becomes what? Integral foreign operations. If there is interconnection between the two entities, it becomes integral foreign operation. Yes, sir. Something which is not integral foreign operation becomes what? Non-integral foreign operation. Like Indian Infosys entity is developing software number 1. 100% of software 1 is developed by Indian office. 100% of another software called software 2 is developed by US branch. Now there is interconnection here or no interconnection? I mean, this becomes what? Now US branch is what? Integral or non-integral? In that case, it will become non-integral foreign operation. Yes, sir. Sir, how to identify whether it is integral or non-integral in examination context? From theory standpoint, if you have to identify whether it is integral or non-integral, in fact, there are some parameters. If you want to call it as non-integral for foreign operations, we look for 5 parameters. 1, non-integral foreign operations. No, are they connected with Indian entity or not much connection? That means that foreign operations should run autonomously, meaning it should run independently. On its own, it will run. It will not reach out to or it will not ask the advice of Indian entity. It will take all the decision itself on its own. That's what we mean by foreign operation running autonomously. That's the first indicator of what? Non-integral foreign operation. Now you tell me, if they are not connected means Indian entity and foreign operations will have high transactions or less transactions. If the transaction between the reporting entity means India, reporting entity means Indian entity. If the reporting entity and foreign operations have less transactions, then that is one of the indicator of what? Non-integral foreign operation. Third one. Okay, they are understanding. That's their way of saying they are understanding. Good one. Little louder. Okay. The third one is, sir, this has become too much, huh? So much excitement for AS11 now. That much I am only not excited. Okay. This will go on for a long period of time now. Any windows are open? By chance, can we close any of them? If it is by chance open, recorded students, you don't worry. Some outside fireworks is going on. Better, thank you. The third one, sir. If foreign operations need money, if they need money, do you think they will call Indian entity? If it is NIFO, they will call Indian entity or they will arrange their own funds? Since they are running autonomously, they will arrange their own funds. That too in which currency? Gandhi note or their own currency? Their own currency. So foreign operations will arrange the funds in their own currency. Fourth one is sales of foreign operations will be denoted in foreign currency. If they are in US, they will make the sales in dollars. If they are in Europe, they will make it in probably euro, like that. Expenses also they will incur in foreign currency only. These are the indicators using which we will identify whether it is a NIFO or IFO. This is an indicator of what specifically? NIFO. Okay. Again, not that very important in the examination context. Sometimes they ask. That's it. Okay, the important part is this. This chart is important. Numerical questions are based on this particular thing. It's okay. We will leave foreign operations for the time being. Okay, that is just first we will take up what I said. AS11 covers broadly foreign currency transactions and foreign operations. If you have foreign currency transactions, you need to identify whether it is a monetary item, non-monetary item, right? Now, what AS11 says is, initially, whether it is a monetary item or a non-monetary item, everything will be recorded at TDSR, transaction date ka spot rate. Everything will get converted at transaction date ka spot rate, whether it is monetary or non-monetary. Meaning, if I sell the goods to my foreign debtor today, I will check today's exchange rate. Today's exchange rate, we call it as what? TDSR, transaction date ka spot. Okay. Doesn't matter whether it is monetary or a non-monetary. All settlements will be recorded at settlement date ka spot rate. All settlement will be recorded at settlement date ka spot rate. What do I mean by that? Sir, if I sell the goods today to my debtor will pay me today, or usually it will be a credit sale. Let's say credit period is 2 months. How much? 2 months. When will the debtor pay me? After 2 months? After 2 months, exchange rate will be same or it will differ? It will differ. whatever is the exchange rate after 2 months when the debtor pays, that we call it as what? Settlement date ka spot rate. All cash coming in, cash going out will be recorded at what rate? Settlement date ka spot rate. Initially using what? TDSR. Inflows and outflows at what rate? Settlement date ka spot rate. Oh. 1 minute, guys. Yesterday it was not there. Today suddenly Josh came off them. Huh? Hopefully tomorrow and day after they'll spare us. Today or including. Okay. Okay, sir. Sir, in between transaction and settlement, there could be one important date called balance sheet date. That is on 31st March. In between this transaction and settlement, if your year comes to an end, then what AS 11 says is, check if you have any foreign currency item which has a balance. Check what? Whether your foreign currency item has a balance. That foreign currency item could be a monetary or a non-monetary. If you have monetary item which has a balance, all monetary items should be shown in your balance sheet reconverted using closing rate. All monetary items should be reconverted using closing rate. Initially you converted using what? TDSR. Now you are converting using what? Closing rate. Do you think these two rates will be same? When you reconvert using closing rate, you will get some forex gain or you will get some forex loss. That will be transferred off to P&L account. I'll give you a numerical here and also we'll take up a question also. Yes. First, let's know the rules as a theory level. Now, this is for monetary item. Suppose if your non-monetary item has any balance, this usually is not tested at your level. It comes in final level. Final also a little less, but just telling you at theory level. Okay. I've not seen questions on this so far. Okay. But quickly, I will just tell you. If you have a non-monetary item which has a balance, then what standard says is first check how is that non-monetary item valued. How is that non-monetary item valued? First of all, what is non-monetary item? Value same or fluctuates? Fluctuates. Property, plant and equipment is what item? Monetary or non-monetary? If you buy a laptop today for 1 lakh, it will be forever 1 lakh or value changes. So what item it is it? Non-monetary item. So property, plant and equipment is a non-monetary item. PP can be valued using cost model or revaluation model. So first you need to check how is that non-monetary item valued. Whether it is valued at cost or some other basis. Some other basis means fair value. If it is valued at cost, you have already converted using what rate? TDS. Continue with that. Further conversion not necessary. Whatever you have converted using TDSR, continue with the same. That means exchange gain loss will come or it will not come. It will not come. However, by chance, if you are valuing that non-monetary item not at cost but at something else like fair value, when will you find fair value? Year ending. That means you'll have to use that year ending fair value. You have to use year ending ka exchange rate and reconvert. If you are valuing it at fair value, on the day you found fair value, that day ka exchange rate you use and reconvert. When you reconvert, initially you have converted at what rate? TDSR. Now you are converting using a different rate. I mean, there will be some balance. That is only your forex gain or forex loss. Standard says that forex gain or loss should be as per the respective accounting standard. That forex gain or loss should be accounted as per the respective. Yes. Like AS 10 says, revaluation gain should go to revaluation reserve. That means forex gain also will go to revaluation. Revaluation loss, where it will go? P&L. That means exchange gain or loss, exchange loss also will go off to P&L. Like that. Whatever the other standard says, same treatment you will give it for exchange gain or loss. Understood? This is anyway not much tested as such. Okay. Just to give you a little number clarity, let's take this. To get this closing rate TDSR, SDSR little better, I've constructed a small example. Look at this. Sir, we have sold goods to one other customer on 1st February 2027 for $10,000. For $10,000. I mean, this is a normal item or foreign currency transaction? Foreign currency transaction, because it is not INR, it is dollars. Okay, now. When did you sell? 1st February. So that means you'll have to pass a journal entry on 1st February. What is the entry for credit sale? Debtors to sale. Can you write 10,000 in the amount column? No, this is not 10,000 Indian rupees. This is $10,000. Correct? Huh? When did this transaction happen? 1st February. On 1st February, there will be a conversion rate between dollar and INR. Let us say $1 is equal to 80 rupees. On what day? 1st February. On 1st February, $1 is equal to how many rupees? 80 rupees assumption. This rate we call it as TDSR, meaning transaction date ka spot. So $10,000 will be converted using what rate? 80. That means it will become rupees 8 lakh. So you will 10,000 into 80, which is 8 lakh. Understood? Debtors to sale, you will pass it as 8 lakh rupees. This is what standard is saying. Initially, every transaction is converted using TDSR. Transaction date ka spot rate. Sir, suppose this is a 3 months credit which we have given. So it's not a cash sale, it is a 3 months credit sale. When will the debtor pay? February, March, April. That means on 1st May he'll make the payment. Okay. 1st May he'll make the payment, right? But between these two dates, between 1st February and 1st May, one important date comes. What is that? Balance sheet date will come, which is what? 31st March 2027. Agreed? Between this transaction date and settlement date, one important date is coming, which is balance sheet date. Okay, Ji? Now, if I have sold goods worth $10,000 to my debtor, how much will my debtor pay? If I have sold goods for $10,000 to my debtor, how much will my debtor pay? $10,000. Value changing or fixed? Fixed. So debtor is what item? Monetary item. Correct? Sir, monetary item means it need not be fixed in Indian rupees. It can be fixed in any currency. It can be fixed in any currency. If I have sold $10,000 goods, debtor will pay me $10,000 only. Not a rupee more, not a rupee, or not a dollar more, not a dollar less. Correct? Now, what does AS 11 say? Between this transaction and settlement date, a foreign currency item has a balance. You have to show in the balance sheet by reconverting at what rate? All monetary items should be reconverted using closing rate. Closing rate means when will you close the books? 31st March. So the exchange rate on 31st March, we call it as closing rate. That's it. Okay, Ji. That exchange rate is how much now? 80. I'll not do the journal entry. I'll show it to you in another problem. But so far, okay. So reconverted at what now? 85. Initially, you converted at what? 80. Now, when you reconverted 85, value is how much? 8,50,000. 10,000 into 85 gives you 8.5 lakh. Yes, no? Initially, you are showing your debtors at 8 lakh. Now, your debtors is appearing in balance sheet at what value? 8,50,000. Debtor balance is increasing or reducing? Increasing. That means debtor, you are now, according to this, debtor will pay you less or pay you more. In Indian currency, you will get less or more? More. So, it's a case of a loss or a gain? Gain. Gain relating to non-monetary item or monetary item? Where will it go? When you reconvert monetary item using closing rate, when you get a gain loss, that gain loss should go off to P&L. This 50,000 gain will be transferred as a forex gain to P&L. That's all. Easy. Everybody good? Okay. Now, when will the debtor pay us? 1st May. How much he'll pay us? $10,000. When is he paying? 1st May. On 1st May, exchange rate will be same or something else? Something else. The exchange rate on 1st May is what we call it as settlement date ka spot rate. That is how much? I've assumed it to be 87. Okay, Ji, that's all. This is all you'll have to do over here. Okay, I'll show you with the journal entry in another problem. But you got the concept of TDSR, SDSR and closing rate? That was the intention of this example here. Again, gain will go off to P&L. I'll show you. Full gain. And the 50 complete gain ala. This took a gain again because 50 you have already done. No? Only extra gain you'll transfer to P&L, which I'll show you. But so far, okay. Pakka. Okay, let's do a thing. Just to have a little better clarity, I'll change the approach here. I'll do a one question. Previously, we saw the example of what? Debtor. I think this is an example of purchase, I think. It's okay. It could be a debtor related or a creditor related. I'll show it to you with the journal entry. You don't have to copy. It's a study material question. Quickly, let's run through. You are required to ascertain loss or gain to be recognized. For which date? Year ended 31st March 20x1 and 31st March 20x2. 2 years ka gain loss you need to ascertain. Fine. As per AS 11. Exchange rate per dollar they have given. Here we have purchased the goods on what day? 1st January 20x1 for how much dollars? $15,000. Okay. And actual payment is what? When are we paying on 1st January or 7th July? So it's a cash purchase or a credit purchase? Credit purchase. First, tell me, what is the journal entry for credit purchase? Credit purchase. Purchase account debit to creditors. On what day? 1st January. On 1st January, what is that? 20x1. You will pass the journal entry. Purchases account debit to creditors. Did you purchase in Indian rupees or dollars? Dollars. How much is the dollar value? 15,000. What does the AS11 say? Whenever you do a foreign currency transaction, whether it is monetary or non-monetary, doesn't matter. Initially, everything will get converted using transaction date ka spot rate. When did you do this transaction? 1st January. On that day, what is the exchange rate? 75. $1, if you are confused whether to multiply or divide, put this dabba. $1 is how much rupees? 75 rupees. How much is the dollar value? 15,000. $15,000 is how much? When you cross multiply, you are dividing or multiplying? Multiplying. That way you will get. So 15,000 into 75. Do in your calculator, how much is that? 11,25,000. This is what? Dollar or rupees? This is converted using what? Transaction date ka spot rate. Easy. First is done. Okay. When are you making the payment? 7th July. 7th July. But hang on. Between this transaction, when you're making a payment, sir, settlement does not mean money coming in. Settlement also means money going out. Okay, settlement means both cash inflow as well as cash outflow. When is the outflow happening? 7th of July. Between this transaction and settlement, one important date is there. What is it? Between these two dates comes one important date called 31st March 20x1. That day, first year will come to an end. Yes, sir? Okay. When year comes to an end, what does AS11 say? Check whether your monetary item or a non-monetary item has a balance. Let's go one step back. Purchases is related to goods. Inventory. Inventory is what item? Inventory is a monetary or a non-monetary item. Inventory forever you will sell it at same price or it depends on condition. If condition is good, you will sell the inventory at higher price. If condition is bad, you may sell it at lower price. So inventory is an example of a non-monetary item. Yes, sir. So this purchases is relating to goods or inventory, which is a what item? Non-monetary item. Leave that. What about creditors? What about creditors? I have purchased how much from my foreign currency creditor? 15,000. So how much will I pay? 15,000. If I purchase for 15, I will pay 15. Value changing or fixed? So creditor is what item? Creditor is an example of a monetary item. What? On 31st March, this monetary item has balance or it has become zero? It has balance. What does AS11 say? If monetary item has a balance, they have to be shown in the balance sheet. They have to be shown in the balance sheet by reconverting at what rate? Closing rate. Closing rate means what? The rate on the day you close your books. When are you closing your books? 31st March 20x1. Have they given that? 31st March 20x1, the rate is now how much? 74. What is the 74? CR. CR as in closing rate. Done now. You have initially converted at what rate? 75. Now you have to reconvert at 74. Take a calculator. Convert 15,000 into 74 you do. 15,000 into 74 you do. How much are you getting? You are getting 11 lakh. 15,000 into 74 if you do, you are getting 11 lakh. 10,000. Correct? Huh? So creditors should appear in your balance sheet at rupees 11 lakh 10,000. But check your creditor balance so far. How much is it? 11 lakh 25. From 11 lakh 25, you have to make it to 11 lakh 10. Creditor balance increasing or reducing? Sir, creditor is a liability. Liability balance is getting reduced. Sad or happy? One liability, if it is getting reduced, obviously we will be happy. So this is what? Forex loss or forex gain. Or if you're confused, no problem. Creditor balance you have to reduce. Creditor has what balance? Credit balance. How do you reduce it? Debit. That means you will debit the creditors. and credit what? And nominal account rule say debit all expense, credit all gains. If you're crediting something means obviously it has to be a forex gain. That way also you can decode. Done, Ajay? How much? How much? How much? From 11 lakh 25, if you reduce 11 lakh 10, it is 15,000. And you got this gain when you reconverted monetary item using what rate? Closing rate. That's all. And this gain, where it will go? Since it's relating to monetary item, it will go off to PL. Need a minute or okay? Sir, what about this closing stock? Have they told anywhere there closing stock is valued at net realizable value? Have they told anywhere closing stock is valued at net realizable value? No. That means closing stock is valued at cost. What did we say? If non-monetary item, if it is valued at cost. If non-monetary item, if it is valued at cost, should we have to reconvert or not necessary? Initially, anyway, you have converted using TDSR. Continue with the same. Continue with the same. That means should we have to find any gain or loss relating to this purchases or closing stock or not necessary? That's what I've written here. Closing stock is a non-monetary item. Since they have not told anything about NRV, we are assuming this non-monetary item, it's valued at cost. Hence, remeasurement necessary, not necessary. Not necessary. Done, people. Done, people. Okay, next. When did you make the payment? 7th July 20x1. So this is what? When you make a payment, it's a settlement. It's a settlement. What does AS11 say? All settlement transactions. Settlement means the payment as well as receipt. All settlement should be recorded using what rate? Settlement date ka spot rate. Correct? What's a journal entry for creditors paid? Creditors paid. What is a journal entry? Creditors account debit to bank. So on 7th July 20x1, first pass the entry. On 7th July 20x1, first pass the entry. What is that? Creditors account debit to bank. Amount we'll see later. Creditors to bank. Whenever you are passing AS11 entries, no, leave one line gap because it could be a forex loss or it could be a forex gain. So leave one line so that you can accommodate. So creditors to bank. Check how much balance does your creditors account have now. Here you credited by 1125. Here you debited by 15. That means creditor ka balance is 11 lakh 10,000. Correct? Huh? You made the payment. So creditors ledger necessary or close it? Close it. Creditor is having a credit balance of 11 lakh 10. How do you close it? Debit. So creditors will be debited at 11 lakh 10,000. Easy. Yes, sir. This is a settlement. This is a settlement. What AS11 say? All settlement should be recorded using settlement date ka spot rate. How much are you settling? $15,000. And what is settlement date ka spot rate? 73. 73. For $1, it is 73 rupees. For $15,000, how much? Calculate. 15,000 into 73 is how much? 10 lakh 95,000. Got it? Huh? Sad or happy? No? Happy. Why? Sir, we thought we will pay the creditor 11 lakh 10,000. But eventual payment came only to 10 lakh 95. Paid more or paid less? Paid less. So it's a case of forex gain. Calculated or balancing figure? Balancing figure. How much? 15,000. That forex gain. It is relating to monetary item. Monetary item forex gain loss always goes off to PL. You can keep this as a thumb rule. There's one exception to that which I'll tell you. But otherwise, all monetary item ka gain loss goes off to PL. There's a fun. That's it. Easy. Carry on. Huh? Okay, come back. So this part of the chart we have covered. Okay. Let's move on to the next one. I think just when this problem ended, I made one sentence. What is that? Monetary item ka forex gain loss goes to P&L. But there is a small exception to this rule, which we call it as para 4646A, exemption or exception. Para 46, this is an important question, has come quite a few times. If you can remember exact words, I think it will be better. Para 4646A, exemption or exception or whatever you want to call it. What does it say? Just simply this para 46. I told you the logic of this in regular class. Now I'll just tell you the crux of this, what you need to do. Sir, listen to this carefully. If you have taken a long-term foreign currency loan, what is it? Long-term foreign currency loan. You're not taking loan in India. You're taking loan from outside India. And it should be not a short-term loan, but for a long-term loan. First aspect is that. Loan is what item? Monetary or a non-monetary? Monetary. Because if you take $1 lakh loan, how much principal will you repay? $1 lakh. So loan taken, loan given. Both are examples of what item? Monetary item. If you have taken a long-term foreign currency loan, after you take a loan, you'll use it for some purpose, no? You'll use it for some purpose. So check for what purpose did you utilize the loan. The two purposes are, first check if the loan has been utilized to buy a depreciable asset, whether the loan is used to buy a depreciable asset or any other purpose. If by chance the loan is used to buy a depreciable asset, then the exchange gain or loss on this monetary item, company has a choice. What did I say? If you have a long-term foreign currency loan, which is used for what purpose? To buy a depreciable asset. All monetary items should be shown in the balance sheet by reconverting at what rate? Closing rate. When you reconvert using closing rate, you will get a forex gain or a forex loss. Usually monetary item forex gain loss, where it will go? P&L. But if this loan is used for depreciable asset purpose, then the exchange gain or loss, company has a choice. Instead of transferring it to P&L, they can adjust it against the cost of the asset. Meaning if you get an exchange loss, you can add it to the cost of the asset. If you get an exchange gain, you can reduce it from the cost of the asset. Because exchange loss means you will debit. Exchange loss means you will debit. Instead of debiting P&L, you will debit asset. When you debit an asset, asset balance will increase. That's the reason we say if it's an exchange loss, you can add it to the cost of asset. Gain means you will credit. Instead of crediting P&L, you will credit what? Asset. Asset has debit balance. When you credit, its balance will reduce. So hence exchange gain leads to reduction in the value of the asset. This is one option given to the company. If the company doesn't want to do this, what will they do? Transfer monetary item gain loss to P&L. That's all it is. Fine. And this is an important question in CA final also. It will carry over this concept. We have like at least 4 or 5 types of questions in CA final also around the same concept. Okay. So good to remember it. Once more, okay. Once more, okay. Okay, Pakka. I'll not go into the logic of all this. Is it okay? The treatment is good enough for you now? Why we do this and all? That's just a backstory to it. No time, but because anyway, it's not relevant much for exams. Can we remember this much for the time being now? Those of you who are learning it for the first time? Okay. Sir, is it necessary that long-term loan should be used for depreciable asset or it can be used for other purpose also? Can be used for other purpose also. If this loan is used for some other purpose, like to buy a land, land is a depreciable asset or not a depreciable asset? If it is depreciable asset, this treatment. If it is not a depreciable asset, or if it is for working capital purpose, if it is to pay salary or some other purpose. If it is used for any other purpose, what AS 11 gives a choice is all the exchange gain or loss, you can accumulate it in one reserve. Exchange gain or loss, instead of transferring it to P&L, you can accumulate it in one reserve called FCMITD or FCMITR, Foreign Currency Monetary Item Translation Difference. Foreign Currency Monetary Item Translation Difference, one reserve. Yes, like revaluation reserve is there. Like that, one fancy reserve. What is that fancy reserve name? Foreign Currency Monetary Item Translation Difference or Translation Reserve also you can call it. Okay. Instead of transferring it to P&L, transfer it to this account. Okay. Now, from FCMITD, you can transfer it to P&L over the loan duration. Meaning basically this is a benefit. Usually forex gain or loss goes to P&L on a deferred basis or immediate basis. But here what choice is given is that forex gain or loss, you can park it in one temporary reserve called what? FCMITD. Suppose you have taken a loan for 5 years. Exchange gain or loss, first put it where? FCMITD. From FCMITD, you transfer it where? To P&L, not immediately, but over. Why 5 years? Because loan ka duration in my example is 5 years. Basically an benefit, because when you transfer expense to P&L, what will happen to profit? Profit will reduce. Due to expense, profit will reduce. But what happened? No, in 2000 something, some years, 2003-4, there was a lot of forex fluctuation. Many companies started suffering heavy loss. They were good companies, but they were still suffering loss due to exchange fluctuation. So their P&L was taking a lot of hit. Hence, this benefit was introduced. That's all is the background. So instead of transferring the loss immediately to P&L, you have an option to transfer over loan ka duration. That way, company ka position also is little safeguarded. That's the thing.
If they don't want to claim that option, they should transfer the reserve to.
This is a choice. This is not an obligation. This is a choice. If company wants to do it, they can do it. Otherwise, they can transfer forex gain or loss on a normal way. What is normal way? Immediately to P&L. That they can do, or this they can do. Choice. For depreciable asset, you wanted to use FCMITD, not allowed. For depreciable asset, always adjust it against cost of asset. For others only, you have an option to transfer it to FCMITD. If they P&L. If this you don't want to avail, means it goes to P&L. If you don't want to avail, means it goes to P&L. Defer or immediately. Like that. Totally optional. Okay. Understood this? When after you account it, you will usually account this gain loss at current year ending, no? Right? So from next year onwards, it will start going to P&L. This year, nothing will come. That is your question. Okay. Can we take up one question on this just to be on the safer side, so that we can have a little better clarity? Or maybe tell me the provision once. Let's see. You tell me once the provision for me. What is this provision? This is a normal rule or an option? Optional exemption. We call that as para 46A exemption. What is this exemption available for? It's available for everything or one component? One component, which is long-term foreign currency loan. Whenever you have taken a long-term foreign currency loan, check for what purpose it is utilized. To buy a depreciable asset or others. If it is used to buy depreciable asset, then exchange gain or loss, you will transfer it to P&L. You can transfer it to P&L, or another option, adjust it against the cost of the asset. If it is used for any other purpose, exchange gain or loss, you can accumulate in one reserve called FCMITD. From FCMITD, it goes to P&L over the loan duration. And this is obligation or a choice? Choice. If the company doesn't want to use this choice, then exchange gain or loss in a normal way goes to P&L. That's all. Okay, look at question number 6. Study material question available in our class notes also. A Limited purchased fixed asset costing. Pay in these sort of question, pay attention to the currency, whether it is rupees or whether it is foreign currency. Here, what are they given? Rupees 3,000 lakhs. So it is Indian thing. On what day? 1st January 20x1. And the same was fully financed by a foreign currency loan taken in what? Dollar. Oh, okay, that means what, sir? I've taken a loan in dollar, and that loan is used to buy what? Fixed asset. Yes, fine. All right. And this loan is payable in 3 equal annual installment. That means you will repay this loan in 3 years. Short-term loan or a long-term loan? It's a long-term loan which is getting utilized for what purpose? Depreciable asset. If they say fixed asset, always take it as depreciable fixed asset only. Exchange rate was $1 was equal to 40 rupees and $1 is equal to 42.5 rupees on 1st January and on 31st December. If they don't tell you anything and if they give you 31st December, that means the indication is we are not following April to March, we are following calendar year, that is Jan to December as our financial year. First installment was paid on 31st December. Obviously, you took the loan on 1st January, you have to pay in 3 installment. No, so first installment will be due in 31st December. End of first year, you paid 1 installment. Balance 2, you will pay over the next 2 years. The entire difference in foreign exchange has been capitalized. Capitalized means have they transferred to P&L or have they adjusted against asset? Adjusted against asset. They have done anything wrong or correct only? Correct only. Because it looks like company has rejected para 46 or accepted. They want to avail that para 46, 46A exemption. Okay. You are required to state how this transaction would be accounted for. Give both the treatment. What is that? If para 46A, 46A is opted, what will happen? If it is not opted, what will happen? Both you will give. That's what they're basically looking for here. Okay, so and you will say that if company has opted for para 46, 46A exemption, then what they have done is absolutely correct. They have followed AS11 ka provisions. Okay, let's, usually in these sort of questions, I say it does not solve. They don't express the numbers. They give the suggested answers always in pointers. Okay, but I think for our better clarity, I have solved it with journal entry so that we can understand it a little better. But my suggestion to you is, as much as possible, try to answer in words. Try to answer in words, not in entries. If at all mind doesn't get clicked, it freezes, then try to answer in journal entries. Because suggested answers will not be in this format, it will be in this format. The closer you write the answer to the suggested answers, the better the chances of you scoring higher marks. But here, for the sake of understanding, I put it up in journal entry format. Okay. Sir, how much loan have you taken? Can you tell me? How much loan have you taken in dollar? Can you tell me? How much loan has been availed in dollars? You have taken the loan on 1st January. 75 lakhs. Perfect. How? Sir, you purchased the fixed asset on 1st January. Loan also you have taken on 1st January. On 1st January, what was the exchange rate? 40. If you're confused about calculation, you can look at it like this. $1 is equal to how much? 40 rupees. How much Indian rupees they have given? They have given rupees 3,000. 3,000 lakhs, all these are. Okay. So that will be equal to how much dollars? When you multiply, it will be what? 3,000. It's a multiplication or a division here? Division. So it is what? 75 lakh dollar loan is what you have taken. Yes, sir. People good. What's the journal entry for loan taken? Bank account debit to, on 1st January, bank account debit to foreign currency loan. How much? 3,000 lakhs. Or you can say 75 lakh dollars into 40, which is 3,000 lakhs. Yes, sir, people. Done now, people. Okay, people. So foreign currency loan is what item? Foreign currency loan is what item? Monetary item. Okay. Doesn't matter whether it is monetary or non-monetary item. Initially, every transaction is recorded using transaction date ka spot rate. That is done. Okay. Now, did any settlement happen? Did any settlement happen in the current year? Of course. One installment, when did you pay? 31st December only, no? So you have paid one installment. How much is the loan you have taken totally? 75 lakh. That means what is the installment amount? 75 lakh you have to repay in 3 installments. So that means every year you have to pay how many dollars? 25 lakh dollars. Agreed? What's the journal entry for loan repaid? Loan repaid. Loan account debit to bank account, or foreign currency loan account debit to bank. Okay. How much is the loan appearing in your books? 3,000. Fully you repaid or 1/3 of it? This 3,000 you will repay in 3 installments. How many installments did you pay in the current year? 1. That means how much loan you will cancel in your books? 1,000. How? 3,000 divided by 3, which is 1,000. Correct? Huh? So entry is foreign currency loan account debit to bank. Whenever you're passing entries, leave one line on the debit side, leave one line on the credit side to capture what? Exchange gain or loss. Foreign currency loan account debit, how much? 1,000 lakhs. Or all these values is not in dollars, it is in rupees. To what? To bank account. 1 second. This is a settlement. This is a settlement. All settlement should be recorded using what rate? Settlement date ka spot rate. Settlement date ka spot rate. How much did you settle? How much did you settle? 25 lakh dollars. When did you settle? 31st December. On 31st December, how much is the rate? On 31st December, $1 is 42 rupees 50 paisa. So 25 lakh dollars will be how much? 25 lakh dollars will be how much? 1062.5 lakhs. This is okay. So you will credit bank account by 1062.5 lakhs. Yes. Journal entry matching or difference? How much difference? 62.5. You thought you will pay 1,000 lakhs. You thought you will pay 1,000 lakh. Final payment came to 1062.5. So you paid less or you paid more. Paying more means gain or loss? Loss. Or balancing figure is coming on the debit side. So it has to be what? Loss. Now don't transfer loss to immediately to P&L because you have 2 options. Hence loss. Now I am parking in one account called foreign exchange difference account. This foreign exchange difference can either be transferred to P&L or it can be adjusted with PP. That I'll do it at the end. That's the reason time being I parked it in what account? Foreign exchange. Or you can simply call it as Forex loss account debit. That is also fine. Done, Aji. So TDSR done, settlement done. That's it or one more? Sir, on 31st December, our books is also closing. Our books is also closing. What does AS11 say? Whenever you are closing the books, you need to check whether we have any balance in monetary item, non-monetary item. Here we have a balance in a monetary item called what? Loan. What does AS11 say? All monetary items should be restated and shown in the balance sheet using closing rate. You should be restated using what rate? Closing rate. Sir, how much loan is pending now? You took a loan of how much? 75 lakh. How much did you repay? 25 lakhs. How much loan is still pending? 50 lakh. Correct? 50 lakh loan is still pending. You have to convert this using what rate? Closing rate. What is the closing rate? You are closing the books on 31st December here. So the closing rate is 42.5. So converted using 42.5. 2125 lakh. What? Rupees 2125 lakhs. So correct? So loan ledger should have what balance? 2125. 2125. Check. Is your loan having that balance? Take your calculator. You're credited here by 3000. Here you debited by 1000. So minus 3000 minus 1000. How much pa? 2000. So currently the loan ledger in our books is showing a balance of 2000. But it should be how much? 2125. From 2000 lakhs, you need to bring it up. A liability, you need to bring it up to how much? 2125. A liability balance is increasing. So gain or a loss? Loss. How much? 125. Make me happy. Tell me the entry. Liability you need to increase. So foreign exchange difference account debit 125 lakh to foreign currency loan 125. There are multiple ways to calculate gain or loss. And I'm just showing you the interest of larger audience. What is the easy way? Okay. So far good. Pakka. That means how much net mein, how much is the loss you have suffered? Here the loss is 62.5. Here the loss is 125. So totally how much is the loss? 187.5 is the total foreign exchange difference or forex loss. And now you will call out two possible treatment for this. What is the two possible treatment? If a company utilizes para 4646A exemption, then this forex loss will be adjusted against cost of the asset. If you want, you can pass the entry. Foreign exchange difference has debit balance. Now you are transferring this against what? PP. This has debit balance. How do you transfer? Credit. Where are you transferring it to? PP. So what is the entry? PP account debit to foreign exchange difference. That's the reason we say whenever you have exchange loss, PP ka carrying amount will increase. That's what I've written in the chart book. If it's forex loss, you'll add it to the cost of the asset. If it's forex gain, reduce. So this is the entry. Clear? If company does not want to use this, if company does not want to utilize this, then what they'll do? Transfer it to P&L. That's another treatment. Either this or this based on company ka option. If you're transferring to P&L, then the entry will be P&L account debit to foreign exchange difference. Both you will call out and you'll give a subjective answer.
Here we got the loss of 25 separately and 62.5 separately.
Total you'll have to take. Total exchange gain or loss, you have an option to transfer it to P&L or adjust it against cost of the asset. Both. Okay. Fine. Everyone good. Suppose it was not a depreciable asset. It was not a depreciable asset or it was something else. Then where you would have transferred this to? Instead of debiting PP, what you would have debited? FCMI TD. Okay, that's another option. That's not there here, but just saying. I think that also has come once in exam, FCMI TD. But I hope everyone knows what to do for that now. Perfect. This is done. This is done. Okay, what else? I think maybe one more I will chill and then go for foreign operations. Yeah. No, it's a temporary reserve created out there. Okay, it's not, this reserve has not come from P&L. See, usually reserves come from what? P&L, right? So that's the reason reserve has credit balance. This has not come from P&L. This is directly what a routing account which they have suggested. So this FCMITD will be shown in your balance sheet under reserves and surplus as a negative number, like your amalgamation adjustment reserve, like that. Okay. Good. Next, sir, think about it. Whenever you are transacting with another country, or whenever you are doing any transaction with another customer in another country, you'll always have this headache. What headache? Forex loss, forex gain. Sometimes you may get forex gain, or sometimes you may get forex loss also. Sir, business person would like to take a business risk, yes, no? Like business related risk they can take. Forex risk and all, do you think they would want to take it on their head? Right? They don't want that headache, yes or no? Because that is not in their hands at all. Right? So what usually companies do is to avoid this forex risk, fluctuation ka risk, they enter into something called forward contracts. Companies enter into some contract called what, sir? Forward contract. Simply they will approach a bank and tell, I have to pay my creditor after 3 months. I have to pay my creditor after 3 months. Freeze the rate. What rate? Freeze the exchange rate today. You will tell the banker. We will tell the banker, freeze the rate, fix the rate today. After 3 months, the rate could be anything. We don't want that headache. We are telling the bank, you take that headache. You take that headache and freeze the rate today for me. Such a contract company will enter into with a financial institution. Such contract we call it as what, sir? Forward contracts. Sir, why will bank take that headache? Bank deal with these transactions day in and day out. That is part and parcel of their operations. They know how to manage that risk better. But as a business person, I will not know how to manage those risks in my view. So that's the reason I am passing on that headache to whom? Bank. Will anybody take extra risk at free of cost, or they will put some tuna? Bank will put some commission. Bank will put some commission. That's calculation is an next problem. So whenever you enter into a forward contract, you will get a good rate or you have to pay extra. You have to pay extra. That's the premium paid on a forward contract. So for us, it's a gain. For a company, it is a gain or a loss. For a bank, it's a gain. For a bank, it's an income. For us, it's a loss or an expense, right? What you'll have to do is first to find what is that loss. First find what is that loss on forward contract. That loss has to be amortized over forward contract ka duration. That loss has to be transferred over forward contract ka duration. If forward contract is for 3 months, then the loss you will amortize over how many months? 3 months. If forward contract is 6 months, then you will amortize the loss over 6 months. More about all this you will learn in India's 109 CFI. Forward contract, futures, options, swap and all that. It will come. But for now, this is good enough. Okay, Naji? Okay, let's look at the questions. Rao Limited, they purchased a plant for $1 lakh. What day? 1st February. Payable after 3 months. Sir, if you have purchased an asset, that to foreign currency asset, you'll have to pay foreign vendor. When? Today or after 3 months? After 3 months, we may pay more or we may pay less because of forex fluctuation. We want that headache or we don't want? We don't want. Company enter to avoid that headache. What will the company do? They enter into a forward contract. Check. How many months forward contract here the company will enter? If you have to pay the customer after 3 months, you will enter into a forward contract also for 3 months. At what rate you are getting now? 49.1. Bank told rate is freezed for you. Rate is fixed for you. How much is fixed? 49.1. Now exchange rate became 50. I am bothered or I am nirvana, Buddha zona. I am Buddha. Why? It can become 50, it can become 60, it can become 30. I don't give a damn. For me, the rate is what? 49.15. Correct? Because I freeze this rate with the banker. That's what you do by entering into a forward contract. Easy, easy, easy. Correct? But bank will give a good rate or not so good rate? Not so good rate. Check, 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 check. The exchange rate on 1st February was 48.85. Now, it will always be a loss if you want to know the logic of it. Sir, now I have to pay whom? Now I will receive or I will have to pay? I'll receive or I will pay? I'll pay. What I have to pay? What I have to pay? Indian rupees or dollars? Sir, I am an Indian entity. I will have money in which currency? Indian rupees, Indian Gandhi note. But I have to pay my foreign currency foreign customer what? Dollar. If I have to give him dollar, first I need to purchase dollars, no? I have to give away my Indian rupees and purchase dollar. That dollar I will give it to my vendor. Agreed? Now check. On 1st February, from the market, if you purchase the $1, how much it will cost? To purchase $1, I have to give away how much Gandhi note? 48.85. To buy $1, I have to give away how much? 48 rupees 85 paisa. But bank is telling to purchase $1, you have to give me 49 rupees 15 paisa. From the market, if I had purchased, I would have purchased for 48 rupees 85 paisa. But bank is charging 49 rupees 15 paisa for $1. That means how much extra bank is commanding? How much extra? How much extra? What is the difference between these two? What is the difference between these two? The forward rate is 49.15. Spot rate in the market, the rate is 48.85. So how much extra bank is charging? 0.3 or 30 paisa. Correct? 0.3. And this is for what? This 30 paisa is a loss for me for total or $1. For $1, the loss for me or the tuna for me is 30 paisa. I have entered into a contract for $1 or $1 lakh. $1 lakh. For $1, this is a loss. For $1 lakh, how much is the loss? 30,000 rupees. That is the premium I have to pay to the banker for taking this risk. Nobody will take the risk at free of cost. So this is the commission which we are paying to the banker. Okay, Naji, Akka Naji. This is a loss for me. This is a loss for me. What did I say? What you have to do for this loss? This loss, you'll have to transfer it over the forward contract duration. When did you enter into a forward contract? 1st February. For how many months? 3 months. That means you will transfer this loss over February, March, April. Why? What am I saying here? Sir, our year ends on 31st March. That means out of this 30,000 loss, 20,000 loss you will account it in the current year. Because current year ends on March. But there is one more month, April, that falls in which year? Next year. That 10,000 balance loss, you will pass it in the next year. That's what you have to write. It is also 2-marker popular question. Wait, proceed. Everyone. Okay, G? Done. Yeah, I think we have done with all the questions. One last concept is there. I'll quickly run through this. This comes in your branch account also. Some of you would have done branch accounting conversion. This is that. Now we know, sir. Now fully we have covered foreign currency transaction. Foreign currency transaction. There is another aspect AS11 covers. What is that? Foreign operations. Foreign operations means what once again? If you have any subsidiary, associate, joint venture or a branch outside India, that foreign operations are broadly classified into IFO, NIFO. IFO means integral foreign operation. NIFO means non-integral foreign operation. Now people, let's say you have a branch in US. We have a branch in US. Head office is there in India. Branch is there in US. Now when you prepare balance sheet of a company, can you include only head office data or you also add branch ka data? You have to add head office ka data and branch ka data. Only then you will get overall company data. But here one headache is there. What is that headache? Head office ka values are all there in Indian rupees. Branch ka all data is there in US dollars. So what do you have to do? Hey, branch ka trial balance you need to convert. From dollar you will have to convert it into Indian rupees. For that you need exchange rate. This is the guidance which AS11 is giving. What rate should we use to convert the trial balance of a foreign branch or a foreign entity? Got it? So what AS11 says is that depends. The exchange rate depends on whether it is an integral foreign operation or a non-integral foreign operations. If it's integral foreign operations, it is same like foreign currency transaction. It is same like what? Foreign currency transaction. Help me out. What is that? All monetary item will be converted using closing rate. Non-monetary item, check how it is valued. If it is valued at cost, TDSR. If it is valued at NRV or fair value, then use the exchange rate on the day you found NRV or fair value and account. Yes, same as that. For all monetary item, non-monetary item, this exchange rate. For all income and expenses, you will use what rate? Average rate. Because income and expenses happens over one day or throughout the year. Hence, recommendation is use what rate? Average rate. Now use your common sense. Some items are getting converted at, there is a trial balance. All the trial balance value is in what now initially? Dollar. Now you are converting it into what? Indian rupees. Some items are getting converted at what rate? Closing rate. Some are getting converted at what rate? Average rate. Do you think the debit side total and credit side total of the trial balance will match or it will not match? Not match. Why? Different components are getting converted using different rates. So trial balance will not match. There will be a difference. That difference you transfer it off to P&L. Why? Sir, integral foreign operations means our own? No. It is just what, sir? Extension of head office. Head office and integral foreign operations are highly interconnected, right? So gain or loss, you straight away transfer it to P&L in that case, because their operations affects our P&L. So hence the recommendation is here, the difference, if the trial balance does not match, in 11th grade we used to do, if TV does not match, you used to put it in suspense. Here suspense is revealed. You transfer where? P&L. Okay, Naji. Suppose if it is a non-integral foreign operation. If it is a non-integral foreign operation, then in fact, if you remember, I used to give father and son 1, son 2 example in class. Those of you remember. Okay. No, remember, not a problem. Non-integral foreign operations, if you have, then all monetary items, non-monetary item will get converted using closing rate. For income and expenses, we need transaction date ka rate. 99.99% of the case that will not be given. If this is missing, we will still use what rate? Average rate. Now these two are getting converted at closing rate. This is getting converted at what rate? Average rate. Trial balance will match or it will not match. It will not match. There will be a difference. That difference you park it in one reserve called FCTR, Foreign Currency Translation Reserve. Foreign Currency Translation Reserve. Whatever is the difference. Now, foreign branch means forever it will continue, or at some point of time you may sell it. When you lose control over that foreign operations, or when you sell this foreign operation from FCTR, you transfer it to P&L. Till that time, this will remain in FCTR. When that foreign operation is sold from FCTR, you will transfer it to P&L. We've done all such questions in branch accounting, if you remember. But the rules are given in accounting standard 11 for those conversions. I think yes, people, that's pretty much what I had in mind to discuss on this standard. 1 minute, let me quickly review. Yes, that's it. Thank you.